Hello everyone. Today we want to cover the group for Chapter 10. We're talking about accounting for long-term liabilities, and moreover we're dealing a lot with the issuance and the handling of bonds payable. So getting into Group Chapter 10, we can see here that Legacy issues $325,000 of 5% 4-year bonds dated January 1, 2015. These bonds pay interest twice a year on June 30th and December 31st. They're issued at $292,181 and their market rate is 8% at the issue date. Recalling the lecture on bonds, we know that $325,000 is the face value or par value of the bond. If it pays 5%, that's an annual percentage rate. Therefore, if it pays twice a year, it's really paying 2.5% every 6 months. And then when we see that they're 4-year bonds, we know that because they're paying interest semi-annually, we'll have 8 interest payments to look at. They tell us here that it's issued at $292,181, and because they're issued at an amount lower than the face value, they're going to be issued at a discount, and we're going to have to deal with that discount. The market rate on these bonds, remember the contract rate for the bond is 5%, but this is saying that the market or the bank pays 8%, and that's why they're being issued at a discount. So first, let's look down here at the journal entry. We're going to record the issuance of the bonds with this par value of $325,000 cash on January 1, 2015. First of all, we have to consider what the company gets. That's us. And of course, we're going to be getting cash. That's why we're issuing these bonds. And if we issue them for $292,181, then that is exactly what we'll be getting. Having a little problem there, hitting the wrong keys. $292,181 is the cash. I certainly know, and I'm going to skip a line for a reason, I certainly know that I now owe bonds payable, and the amount I owe is always going to be the face value or par value of the bond. I use those two terms synonymously. And therefore we know that I have a difference. And if you remember, the difference is always going to be either the discount or premium. Again, if we're going to issue for less than face value, then we're going to be issuing at a discount. It's quite obvious that we need a debit here in order to make this journal entry straight. So we know this is going to be the discount on bonds payable. We just need to calculate the difference. The way we do that is we take our face value of $325,000 less our issuance of $292,181, and it looks like I need a little more space in that column, and that will give us our discount of $32,819. Alright, we can go ahead and record that entry and roll down to number 2. So now we want to determine the total bond interest expense to be recognized over the bond's life. So let's see what we're looking at here. They're asking us what we have to repay. That's the best way to calculate it. How much money do you have to repay after you issue the bond? So it gives us blank payments of blank. Well, just because this is plural tells me that they must be looking for periodic interest payments. Well, again, if we look at the required information, it's a 4-year bond, but it pays semi-annually. That means we're going to pay 8 interest payments. So we know that it's going to be 8 interest payments, but now what it must be asking us for is the amount of each interest payment. Hopefully you remember how to calculate interest. It's going to be the value times the rate times some time period, correct? So if we have, remember the value when we calculate interest must always be the face value. So 325,000 times, we know that it's 5%, and then times however often we pay it. If we're talking about a year and the 5% is an annual basis, if we pay interest semi-annually, then we pay it twice a year, or we need to look at half of the amount. So if I work that out, so plus 325,000 times 0.05 times 1 divided by 2, I will get an interest payment of $8,125. And when I pay those 8 payments of $8,125, I will have paid in $65,000 worth of interest. Now it asks us for the par value at maturity. That's the same as face value, $325,000. And this means that by the time this bond reaches maturity, I will have paid in $390,000 back on the bond. However, how much cash did I actually receive? And the answer there is the issuance price of $292,181. And if that's what I issued it for, then this bond has actually cost me $97,819, $65,000 in interest plus the $32,819 in discount. It's just another way of calculating it. Could I have simply said I'm paying $65,000 in interest and add the discount? Absolutely, and that would tell us what our bond interest expense is for the entire life of the bond. So now it comes down to where they're asking us to prepare a straight line amortization table for the bond's first 2 years. They're looking for the unamortized discount and the carrying value of the bond. And what they're really dealing with here, and we may just expand out our Excel table just a little bit. I'm going to go ahead and throw those dates in there because it's only asking for the first few payments, not all 8, of course. And it wants to know how much the unamortized discount is each period and how much the carrying value is each period. I'm going to go ahead and expand these out as well, just to give us a little bit of room. So I'm going to put the unamortized discount here. We already know that that's $32,819. That's what that unamortized discount is. The UA discount is $32,819, and the carrying value of the bond is always the face value minus, that's the face value here minus the discount. So the carry value at this point is $292,181. Well, if we're going to amortize this amount over 8 payment periods, that will tell us how much we have to remove from this amount in each period. Let's just do that math real quick. So an amortization, let me back up, straight line amortization of the UA discount is going to be plus $32,819 divided by 8 payment periods is what we'll be looking at. And we'll see that that's 4,102.38. I'm just going to go ahead and round that to 4,102. So if the first period I make my interest payment and I pull my my unamortized discount down by 4,102, I'm just going to say minus 4,102 here, then this is now 32,819 minus that 4,102, and this is going to be the carrying value plus the 4,102. So you'll see that every period the unamortized discount will go down by 4,102 and the carrying value will increase by 4,102. So we can just continue to run that same math. If I were to copy this on down, I can now do the same thing down here by just saying plus this minus the 4,102 and this plus the 4,102. And it just continues that way. And of course Excel makes it nice. We can copy and paste formulas. And you'll see that every period it just changes by 4,102. If I were to actually carry this out for all 8 periods, here I've got 4, and I'll just do period number 6, 7, oops, wrong way, 5, 6, 7, and 8 instead of putting the dates in. If I were just to continue this down, you'll see what happens here. And it might have a slight rounding difference at the very, very end. $3 rounding difference at the very end would get us up to that $325,000. But the problem only wants these 4 periods, and that's really what we're looking at there, folks. So the $32,819 gives us a carrying value of $292,181. I don't know where it all went, but I know I typed it. and then 28717, 296283, 1231 it was 24615, 300, 385, 2513, 304 487, 16411, and 308 589. And that will complete the amortization table for the bond's first 2 years. All right, so now we get down to the last of the group work, and it asks us to record the interest payment and the amortization on June 30th of 2015. I'm going to pull my Excel sheet back down. All right, so when we're paying interest, certainly interest expense is going to be our debit. It's bond interest expense, and I just want to go ahead and flesh this out. Every time that I'm paying bond interest expense on a discounted bond, we're going to have 3 lines on the journal entry. One is going to be bond interest expense, and then we have to take out a part of the discount on bonds payable. We know that's going to be 4102 each time. We just calculated that over here. And then, of course, I'm going to pay out some cash. The question is, what does all of that look like to us? Well, I think I've pretty much figured all this out already. The bond interest that I'm paying out in cash, if I go up to my top chart, says that I'm going to pay $8,125 every single period. I'm going to pay out that $81.25. So that goes out in cash, and I know also that I have to add to that $81.25 my discount for each period. So if my interest is always increased by the discount, the cash paid will be $81.25, and the discount will be $41.02. And once I add those things together, I've got phones ringing all around me, as you can hear. Then I can calculate my total bond interest expense, $12,227. And I wanted to do that first because maybe I didn't know exactly where I was supposed to do this, but now I can see that I obviously need that $41.02 sitting over there as a credit. So the first interest journal entry for this bond, June 30th, gives us these 3 lines. So if we go ahead and record that, and it says record the interest payment, the very next interest payment, which is December 31st, 2015. Well, because it's a straight line amortization of the discount, every single interest payment is going to be recorded exactly the same. So bond interest expense, $12,227. The discount on bonds payable will get a credit for the $41.02, and the cash paid out will be $8,125. Hit record on that entry. Just because I haven't been checking my work, I'm going to go ahead and look at it real fast just to make sure that I didn't have any errors in there. And looks like everything is looking pretty good with that one. We'll go check this next one up here. I didn't check it. Yep, answer is complete. Good. And one more, and we'll have this thing done. Oh, 2 more maybe. Good to go. Very good. All right, so go ahead and hit save and exit or submit. Remember, you won't get graded for it until you hit submit. If any of you have any problems with this, please send me an email, and I'll be able to answer it for you in that regard. Hope you guys have a great one, and see you soon.